Welcome back to the Compass. We're recording this episode on Tuesday, June 8th. It's in the morning. It's around 8 a.m. in the morning, and so want to timestamp that because the tariffs are coming back to a place near you here as news rolls out. So, would argue that anything we say could be by the time this airs could be a little bit stale. With me, as always, is President, CEO, and CIO of Olive Resource Capital, Sam Pelez. And my name is Derek McPherson. I'm the executive chairman of Olive. I think we're going to talk a little bit about M&A. There was some news out yesterday, and it's worth having a discussion about not just M&A, the actual deals that are going on and what we're looking for in the market, but also why there isn't more of it. But before that, this morning we put out our investment performance for the month of June. We had another good month, and so Sam, I think it's worth mentioning briefly.
Yeah. So on the press release this morning, our assets are up to just over 8.5 million from just under 6.5 at the beginning of the year. This is after all of the expenses and costs associated with running the company. We're pretty satisfied with that performance. That rounds out to about 33% for the first half of the year. We're not as high as some of the gold exclusive products are, which obviously we're not one of those. We're a more diversified resource portfolio. Previous episodes, we've talked about 50 to 55% of our assets are in precious metals. But the performance of 33% year to date builds on quite fantastic performance we've had over the last 2 years rebuilding this portfolio. So we're pretty satisfied with what we've achieved in the past few years, but also year to date. And some of the companies that have performed quite well for us have been Omai Gold Mines, of which Derek is a director. That company has had a fantastic year this year so far. That trend seems to have continued into July. Same with Troilus Gold. Which we've mentioned it a few times on the Compass as a company that we quite like. It's finally seen some decent re-rating from the 30 to 39 range now into the high 60s, sometimes above 70. So that's also a company that, for us on our books, we're up over 100%. And third but not least, and a company that we'll talk about here as it relates to the M&A and what implied valuations we can ascribe to the company is Sailfish Royalties. We bought a convertible debenture on this company a while back. We have converted it, and we are, again, something like plus 100% in the money on our investment. So those three precious metals related have been key drivers for our performance and companies that we continue to like.
Yeah, it's another solid month, and we continue to, as we are a broader resource portfolio, we are actually looking at things outside precious metals at the moment. But that's a topic for another day, and we covered that a little bit in a prior episode. Now shifting focus to M&A, that always something that's near and dear to investors' hearts because you get that instant premium. You wake up one morning and the company you own is taken out at a 30% premium. You made some money overnight. Now we all know M&A is not an overnight success. Actually, M&A is very, very hard to actually execute and get done. I want to talk a little bit about that. But what brought this topic up was a couple things happening markets-wise that kind of spurred us to think about M&A a little bit deeper, and then also maybe educate you guys on what it takes to actually get a deal done. But the news that came out yesterday was Sandstorm and Royal Gold. Sandstorm has always sort of been the bride at the altar, for lack of a better description. It was the smallest of the large royalty cos. It was eventually going to get taken out, and lo and behold, it has finally happened with Royal Gold acquiring it. Sam, you ran the numbers on that, so let's. Why don't you tell us a little bit about the deal and then our thoughts?
Yeah. Before I get to the numbers, important to also remember that Great Bear Royalties was also taken over by Royal Gold, one of the more acquisitive royalty companies out there, at least on the M&A front. And going over to the numbers, I do have to admit that I did not model all the 230 royalties that Sandstorm has in its portfolio. I just obviously went through the bigger ones and just rounded out the numbers as we got into the lesser ones. But the way we like to value royalty companies, and you've probably heard about this before, we mentioned it in a previous episode, is I like to look at what are the attributable ounces to the royalty company that we have certain degree of certainty that will be delivered in the current plans. And then we like to look at what the company's worth, in this case, what it was being purchased at by Royal Gold, in relation or as a percentage of the spot gold price. And that number usually is something between 60% and 100%. Depends on the transaction at the time. And in this case, I came up with about 88% using $3,400 gold. Obviously, the extra dollar or not here doesn't really add much. That's pretty much in line with what we've seen for other royalty companies, M&A transactions. If we go back a few years, when Triple Flag bought Fosterville and Young-Davidson royalties from Centerra, we estimated at the time on spot gold of $1,290 that was about 93% of the value of the attributable ounces. Naturally, with the gold price increasing, that was a heck of a deal for Triple Flag. And similarly, going further back, when just bringing this up, when Royal Gold took over the royalty on Arrow, we estimated that was about 78 to 79% of the spot gold price. So as you can see, there is this type of range where the royalties seem to be valued at. I know people like to value them at NAV. We are not huge fans of the NAV calculation because there's more inputs, and the more inputs you put into a model, obviously, the more you can affect the output. So in this case, the only input is the attributable ounces and the spot gold price. So we feel pretty happy about this model. So on that 88%, and at the risk of jumping too far ahead, I wanted to bring up Sailfish, which is one of our key royalty investments. And if you apply the 88% of spot gold to what we estimate the deliverable resource for Sailfish is from San Albino and Spring Valley, we come close to a valuation of about $350 million US all in. The company is trading just under $150 million US enterprise value. So what that tells you is roughly, based on these numbers, I can see about 150% upside on Sailfish if the Spring Valley comes in as expected, and we're obviously monitoring how that asset is going to be advanced and developed. I went through the comps on some of the transactions on the percentage of spot for the royalty companies. Okay. I estimated Sandstorm was 88%, which is pretty much in the range. We've seen 70s to 100. So on the comp value for Sailfish, if you apply the 88% with spot gold of 3,400, we get to about 350 million US in value for the company. That company is currently trading about just under 150 million US enterprise value. So net, I see it as a give or take 150% upside from here.
Yeah, I think that's a great, it's why we're invested, and we see that upside. I guess there's a couple points. Obviously, two things, right? Sandstorm's a diversified royalty company, so it might be a little bit of a stretch to apply to a company that has a one producing royalty and a tier one development asset. But it is that tier one development asset is on the path to production. But the other thing is that the flip side of that is they have a tier one development asset, which I think is the part that is for
value.
Right. That's the thing the royalty companies value, and that's what attracts the premium valuations. Not to go back in time a little bit, that go back to that the origin royalty transaction, which was I think in similar valuation was premium.
Right. So, I guess the intention more than talking about Sailfish, I think it was just important to highlight it. But we wanted to talk about M&A and how complicated it is and how many transactions actually fail. We are going to talk about one that just didn't go through publicly, but how many of them fail before they're made public. And on the Royal Gold to Sandstorm, I wouldn't be surprised if this is the third or fourth go around over the last 10 years between those two companies and potentially others that we're also looking at Sandstorm. It's it takes multiple iterations, usually multiple years, and typically just like an alignment of the planets at a certain time for M&A to actually go through.
Absolutely, M&A is very complicated. So the deal you're referring to that failed publicly was one that where we're an investor, and I don't think it affects our thesis. We like the deal, but I don't think it changes the value proposition that much because of what they were acquiring. But that was Valor. They weren't able to get the votes, the shareholder votes. But again, that was a deal that was negotiated at a different gold price, and they were buying a gold company, and so it didn't go through. They weren't able to get the shareholder support, which that is literally the last phase of M&A, right? There's 17 things that have to go right. The other one that's interesting, and it's worth mentioning here, because we're invested as well, is Canex and Gold Basin, where the M&A makes a ton of sense, but the parties can't agree. And so we're invested. We're shareholders of, for full disclosure, we're shareholders of Canex. But the part, they can't get to the finish line. That's a value creation activity for what we think would be a value creating activity for all shareholders. We put two projects together that are right next to each other. Unlike a lot of M&A, it actually has real synergies. So maybe just take a step back, and talk about what it takes to get a deal done. I was sketching this out before, and we've done a few deals, so I've done a few deals, so it's not as many as an M&A banker, but I've done enough to have the scars to know what's going on. Where does it start? It generally starts with a conversation. Two guys pick up the phone and call each other and go, "Hey, do you think there's something to do here?" And then the next step is an LOI, right? So letter of intent. Again, now you've got the lawyers involved. It's a letter of intent is basically worth the paper it's written on. It's here we kind of outline terms on a rough basis. Usually you set exclusivity because you're going to launch into some kind of due diligence, but that's the next step. So there's a negotiation that occurs around the LOI. That can and can't happen. Usually when you sign the LOI, you have to get your board support. You have to get support of your board as well. So it's not just two CEOs agreeing to disagree, agreeing to get to talk, I guess, for lack of a better description. You've got, most average company has 5 people on the board, and so you've gotten 10 people to agree that it's a good idea to talk. The step after that is due diligence, and there's kind of 2 phases of due diligence. And some of this might happen before the LOI as well if you've got a CA signed with the company. But the due diligence is really, there's the project and technical due diligence. So that's one aspect of it, right? So in a mining company, you're looking at if you've got a model or some of the assay data and things like that, and decide whether is this project really what they say it is it worth what we're going to have to pay for it. The second part is legal due diligence, and this is the part that like a lot of investors don't see, right? Like you have to prove that you own the property, that if there was an option agreement that was terminated at some point in the past, that was done properly, or was through, that some sub from 15 years ago is closed, and that isn't a liability that's going to come back and haunt you at a future date. There's all these things that sort of come up as part of the as in that due diligence, and it's very intense and very expensive. You can spend $50,000 to $75,000 just on legal due diligence for a merger. Then, so if your LOI and your due diligence go, then you have to go to the definitive agreement. So those high level terms you negotiate in the LOI, and this is probably 60 days ago. Now you have to get, and you've done all this due diligence, now you have to get the definitive agreement. So these are exact terms. This is what everyone's warranting, they're repping, what they're going to provide as data. Maybe you have to get lockup agreements from insiders. Usually get lockup agreements from insiders. Maybe you get some key shareholders as part of that process. That definitive agreement's usually a 30 or 40 page document that's negotiated. So now you have management teams and lawyers from both sides involved. Maybe you have bankers involved at that point. And so then you get to the end of that process and you have the definitive agreement. Then you announce. So that's the next. Now you've taken this thing public, right? You've gone to the market and said, "Here we are." Now, prior to definitive agreement, you may have wall crossed a couple, usually later in the process, you may have wall crossed a couple of key shareholders and said, hey, we're looking at doing something like this. What do you think? Because what you don't want is the agreement to fail at the end. What you want is that, that once you sign the definitive agreement, you go public, that you get that, you have that support. So now you announce the deal. People all over will tell you what is right and wrong about the deal. I promise there's everyone has an opinion on and the reality is you've done a huge amount of hard work as a management team to get to that definitive agreement, and then everyone's got an opinion on what you did wrong. It's really nice. It's a pleasurable experience, but you think you're doing obviously you think you're doing the right thing, otherwise you wouldn't have signed a definitive agreement. Then generally you've got to get a circular done. So depending on the type of merger, you might have one or two circulars. Right. So if it's a kind of a merger of equals or companies are the same size, you'll have two circulars. Both companies will have to file. If it's, if a larger company is taking a smaller company, usually only the smaller company has to file a circular. Circulars take a huge amount of work to get put together. It's another 150 to 100 page document that has, everything about the company that ever existed. Usually you have to talk about everything that happened in an M&A process as part of that as well. Then once the circular's out, then you have a vote. Hopefully the vote's successful, and then you actually have to close. So there's the vote, while from an investor perspective, usually the vote means the end. From the management side, you actually have to get through the process of transferring control of subs and bank accounts and signing authorities for all those subs and all those things. And then you've actually closed your deal and you can move on with your life. And now you can benefit from all the things that you said, 6 months ago that you thought was a possibility when you signed the LOI, because that's, that time frame and all those things, that's what it takes. And frankly, that's part of the reason more M&A doesn't happen. It's hard.
I think after this very eloquent explanation, you still missed some of the internal dynamics within the discussions with the board. How sometimes you have to get bounce back documents in terms with your own board multiple times, and same on the other side. That could completely derail this at any point throughout the whole period where you mentioned it before it goes public.
Yeah.
So the number of stakeholders involved, it's quite large, and it's almost like an art to keep everybody interested and kind of like emotionally connected with the idea, while you're bouncing back, talking with the lawyers and doing due diligence, and not lose the attention of the people around you. Across all of these stakeholders, some people are very good at it, but generally it's a very challenging process.
Well, I mean, I 100% agree, right? There's M&A is a big public event, right? Any kind of M&A transaction. And so there's lots of liability to go around. So people have an opinion. But I think people look at it as an investor, you kind of look at it, company A is negotiating with company B. Well, the reality is that it starts with, management team A negotiating with management team B. But reality, management team A has to negotiate with his board. It has to have discussions with his board, and management team B has to have discussions with his board. So all of a sudden you have a negotiation that has 10 parties in it. Then, and then you add in the lawyers who are just making, their job is to advise you and make sure that you actually get the deal done illegally and expeditiously as possible. But they obviously have opinions. It's what you pay them for. And so that muddies the waters. And heaven forbid you have a second, like if you've got a special committee and that committee has its own counsel, and then there's other dynamics. These things are very, for lack of a better description, they're very, very complex. It starts as a simple CEO A says to CEO B, hey, we should get together. And then it spirals out of control from a complexity perspective. And I think that's a great point, right? It's not a one-on-one negotiation. And I think that's for lack of a better description, you're often herding chickens, right? Because you got to convince your board. Maybe you've got a couple major shareholders that you had to convince. That was something that, that we saw when we were selling Rockcliffe. It wasn't just that the board had to agree or that we had to have a willing party on the other side. We had two major shareholders with ourselves and Greenstone, and we both had to agree on whatever the other side was. The other complexity is a lot of these M&A deals come with concurrent financing, right? So now you've got you got to announce this deal, and then you got to go convince a whole bunch of other people that you're going to sell the financing. And the board's got liability, right? And so we're kind of describing as this complexity with the board, but the board's got liability, right? They have to act in the best interest of shareholders, and so they have a fine balance. Does the deal make sense? Is it the best interest of shareholders? Is there other options out there? What's the go it alone scenario look like? I think sometimes these situations get overanalyzed by the parties, and that can lead to failure and can grind these processes much slower.
Yeah, and you've done more than I have, but talking from experience, it is incredibly difficult to get an M&A deal over the line. Going back to Valour, we skipped a little bit over the details. Valour was seeking to merge with South Atlantic Gold. They're both in Brazil. They have similar land packages in the same district. It was a pure logical consolidation play. But as you mentioned, once you got to the public realm, gold prices run, and perhaps the ratio at which the companies had agreed to merge no longer made sense to shareholders of the target company, and ultimately did not receive the support from shareholders. But even after you go through all of the hassle that you just described, you then, in most cases, not always, but in most cases, you have to put it out to a public vote. And that opens the possibilities for anything to happen. In most cases, you actually get through with it. In some others, few, but some of them quite visible. What comes to mind is the Calibre Marathon acquisition that took place, I want to say last year, right?
I think you're thinking of Calibre Equinox. Calibre, there was doing an at-market merger, and there's the dissenting shareholders that push for a premium for Calibre, which made sense.
Right. Yeah. Sorry. Yeah, that's what I was thinking about. But yeah, even when you get there, like, you could get dissenting shareholders, and it's always a risk. There's a lot of risk when you submit these things to a vote, but this, frankly, is the right thing to do. Give the shareholders of the company the opportunity to validate the work that the management and the board have been working towards.
Right, and often it's on management to communicate that opportunity and that potential. I think the other thing that's kind of one of the things that we didn't even contemplate across the board was a hostile, and like. I think in Canadian capital markets, unseating an existing management team via a hostile action period is incredibly complicated and very expensive. We've looked at this for other companies in our portfolio. You're looking at a ticket in the neighborhood of $200,000 to $300,000 to get something like that done. Plus, then you have control of the company now that you have to manage and deal with. And that's on the low side. If you're doing it on a small company, forget about a larger company. That's going to be even more. Even a hostile merger, right? It's the biggest risk with hostile merger is the pitfalls that come with it, right? There's always little booby traps in a company that you acquire, things that you don't know, you can't see in public disclosure, right? And you hope to surface a lot of that in due diligence, or maybe you surface it in due diligence and think, it's not a big deal, but at least you know about it. I think with hostiles, you don't get that opportunity. You don't get due diligence with hostile takeovers, and so it can be much more complex. I think I as I was thinking about this topic and I came up with kind of three reasons why M&A doesn't happen. Right? I mean, we've talked about the complexity and how difficult it is to all the steps you have to go through, and keep in mind, each step along the way, you're convincing, you start with convincing 10 people. Right, to get to the definitive agreement stage, on your boards and management teams, and then you do the circular, and then you have to convince thousands because you have your shareholders, depending on how broadly disseminated your stock is, and so those are huge challenges. But then why does M&A fail? What are all the things that at all these stage gates, that all these steps that occur that just really throw a wrench in things? I think a big one is greed. And greed is huge, and there's two aspects of it. And I've seen both in work that we did. There was a time I spent Gold 79, when I was CEO there before it became West Point, I spent over a year looking at, opportunities to merge a few companies together and see if we could get something done. Eventually we got something done with Bullet and it became West Point. And I think it's a pretty good success, but I saw there's a lot of failures in projects that I thought, or companies that I thought, yeah, we could probably do that deal because I like the project. And I think the biggest one is greed. So, and the obvious one is you think your company's worth more than the other party is willing to pay for it. That is it's a simple, and it could be you as the management team, it could be the board of your company, and it could be your shareholders, right? And all three of those groups have to be convinced that the value is there, or that the pro forma plan is worth more than where they're at. I think that is we are in capital markets. The idea is that you shouldn't get maximum value, but generally speaking, if 1 + 1 = something more than 2, you're going to accrete some of that value. And frankly, a lot of people have unrealistic views as to what they think their companies are worth. It's my experience, both flat out that you have people who just don't understand what their companies are worth. Frankly, I love the Rick Rule quote on exploration companies, which is the intrinsic value of most exploration companies is 0, and that's actually accurate. The other thing that you can get in trouble that can stop you though is management greed. Every executive out there of a public company has a change of control clause in their contracts. Every single one. I promise you. Sam and I have them. I have them in other companies. They are very typical, or most do. Sorry, the majority do. And so those change of control agreements can be reasonable or they can be unreasonable. And the other part of those change of control agreements that can be reasonable or unreasonable is how management will deal with them. If you're doing a merger where you think you're getting a good deal and it's going to create value for shareholders, maybe you'd say, hey, listen, I'll take my change of control payment shares alongside all my shareholders that are getting shares in this company, because I think that's a productive, that's productive.
Good deal. Yeah.
Good deal, right? Especially if you have a high change of control payment, right? I'm not here to renegotiate. You negotiate something with your board at some point in time. I'm generally not going to renegotiate. But if you want a big chunk of cash from 2 minor exploration companies, I think you're doing, and that killed some things that we looked at back in the Gold 79 days. There's just this unwillingness to negotiate when it comes to their own money, but they're happy to issue shares to shareholders, kind of thing. So greed's bad in the case of M&A. You want to be a little bit greedy, but if you don't ask, you don't get it. But you don't want to be too greedy to kill things. Second thing is structure. Like I know this much about it, and there's this much to know, but how you structure a deal actually matters. Whether both companies have to vote, whether you get one company to vote, all of those things. And then there's the underlying structure of where the subs are. I looked at a merger with a company that had majority U.S. shareholders. That's a complication in and of itself, because you're as soon as you have more than 50% U.S. shareholders and you check a couple other boxes, all of a sudden you're regulated by the SEC, and so those things are all that costs extra money, and it changes your D&O costs and all kinds of things. This can kill a deal in and of itself, just because it gets so complex that you're like, we just can't get there. There isn't a solution to get through this to get there. And I think that's something that people don't appreciate, or you find. And then there's obviously the last thing is the deadly surprise, the unknown at the LOI stage becomes the known liability that you don't really want to deal with, or don't want to have to deal with. And some of that could be like a dead sub. You have to remember that a lot of public company, right, because of the popularity of the RTO transaction in Canada, these public companies are existing corporate entities for decades, 30, 40, 50 years, right? Some of them. And so there can be, you have to be very diligent to make sure that there aren't skeletons in the closet that you have to deal with. Some of those things come up during M&A. So it's like, especially as you go into detailed due diligence, some of them you just accept and it's all risk weighted, right? Like, it's like, okay, well, there's a low probability of that being an issue, so we'll take it on. Whereas there's a high probability of that being an issue. Maybe there's an employee that wasn't terminated properly somewhere in the background, and all of a sudden that's a $300,000 liability that you're you're staring down the barrel of that you didn't expect to get. Something we might know something about. So yeah, I think that there's lots of reasons that M&A doesn't happen, but I think for investors out there like us, and for everyone else, there's not a reason. It can be done. It is hard. You have to work at it as a management team, but there's no reason that it shouldn't happen, and it needs to happen more in our space because we need fewer companies.
Yeah, 100% agree with that. We have been working towards that ourselves. It's not a mystery to everybody listening here that our main focus for growth is scale. And we've been looking aggressively at M&A opportunities, and all of the facts that you have described are things that we have actually come across in our due diligence, or generally in our search and conversations with potential targets. And as much as there's a lot of times will to do a deal, there's just no alignment of the parts. And leave it to a lawyer. I was laughing because when you're saying about the liability, the uncovered liability, leave it to a lawyer to find out all these liabilities that have been previously unrecognized, even by the target company themselves. Sometimes they operate themselves without knowing that they're carrying this liability themselves.
What you quickly learn when you do any kind of detailed due diligence is that the majority of public companies in the mining space in particular are very poorly run, and poorly run from a corporate management perspective, as far as keeping things up to date with refining authorities and things like that. They're just it kind of, a lot of stuff gets glazed over because they're small companies and they're trying to get things done quickly, and then that stuff becomes a huge problem. That's stuff that comes back to bite you later, and you need to be really on top of it. Don't be surprised if your favorite little junior has some internal corporate structure issues.
Yep. All right. Not to discourage people, but this is the reality of M&A.
Yep.
So when you see something like this, full circle to the beginning, the Royal Gold for Sandstorm, a $3.5 billion US takeover. We welcome. I'm happy when I see these types of transactions. I know how much people involved have worked to get it to this point, and like you said, I think we need fewer companies, fewer and more, and stronger companies, and M&A is certainly one of the key ways we can get there.
Yeah, some should still get taken out back and get shot, but M&A, and M&A, and good on people for trying, right? Like, good on Valour for putting the effort forward. They did everything they could to get that done. It didn't happen. And I think we need to see, we didn't mention it, but the other one that kind of we mentioned, Canex, is a deal that should get done. The other one is Rupert and Orion, right? There's a whole saga there that's gone on for a while, but I think that there's, if you get two parties that that's a 1 + 1 = something more than 2 transaction that should probably happen. And people are getting in their own, depending on which side of the fence you're on. We're on the Orion side, so depending on which side of the fence you're on, people will have an opinion as to who's getting in whose way as to get it done. But I think that it's the same thing, is that it's hard, and it's hard because you've gotta convince a lot of people to do things, and you've got to do it right. You're effectively getting married in 6 months, in less than 3 months of dating, right? That's what you're doing, and so you have to. It takes a lot of people skills to get it done, because there's a lot of people to convince to get M&A over the line. So with that, looking forward to more M&A this summer, particularly in our where we like to see it in gold development names. But we'll talk to you soon. Thanks everyone for tuning into this episode of The Compass.